Welcome back to the one person tuning in. This is Ara Gregorian with the Whip Report again. In this lesson, I'll be covering the retained earnings balance, in particular, rolling retained earnings. So, what we're going to start off with is the current year, which we're going to assume December 31st, 2022 is the current year. I'm your CPA. Okay, you send me your trial balance. This is what I get. Okay. So I look at this retained earnings and I'm wondering if this is what the balance should be. Will this allow me to roll the retained earnings on the financial statements from the prior year into the current year? How I do that is pull up the prior year. So what I'm going to do is pull up the trial balance I received in the prior year and compare it to what this balance shows. And how I do that is I take the retained earnings balance stated here from 2021. I add the revenue, I subtract costs and expenses, and I get what the expected balance is here. You'll notice I've been using negatives for the credits, positives for debits, just the natural account balances. But what this is saying here is that the expected retained earnings balance is off from what the actual balance is. It's off by 25,000. Now what retained earnings really shows is the balance as of the beginning of the year, which I know it's a little confusing. It says December 31st, 2021, but this is technically January 1st, 2021. You take that balance, which includes the prior year retained earnings plus the net income from the prior year. That's how retained earnings rolls. It should be what the balance is in the current year plus your revenues minus your expenses. That's the expected retained earnings balance. Now back to this example, we see this is different. Okay? Something was done after the fact. This was the unadjusted trial balance that you provided to me. I did my journal entries, whether it be WIP, depreciation, so on and so forth. And I got to a different set of books. So what I like to do is request the current version of the December 31st, 2021 trial balance. And by that, I mean if you were to go into your system now and give me the trial balance as of December 31st, what would it be? So you can see here just right off the bat, different debits and different credits. This is the trial balance you gave me last year. This is the one you're giving me this year for the same fiscal year. So what I'll do is do a comparison of what you gave me last year versus what you're giving me this year to identify the differences causing this $25,000 discrepancy between what's expected and what actually is. So you can see here that's what's being calculated. You go down accounts receivable. When you gave me the trial balance last year, it was 21,000. A journal entry was recorded on your end, which reduced it by 5,000. So go all the way down and you identify all these discrepancies, and you see this was the ultimate effect. You essentially decreased net income by 25,000, which rolled through the retained earnings balance, causing it to be off because it should be 440. Instead, it's 415, which is 25,000 less, meaning you had more expenses or less revenue that caused that difference. So that's how you determine the difference. Now, really researching and seeing what caused this will be a topic of another discussion. Thanks for tuning in, and I'll see you later.